In this lesson, we really begin to see what is involved on the charts, what we're looking for in order to frame out potential trades that are going to be positive to our bottom line. What we're not going to do is we're not going to chase price, either in the upward or downward direction. We're going to let trades come to us by way of understanding what the highest probability chart patterns are that typically play out over and over and over again. Which is why now we begin to talk about pattern recognition. What is pattern recognition? Inside bar patterns, retracement patterns. We're going to look at all these types of patterns that have high probabilities of success, whether it be on the bullish side or the bearish side. What I'm going to do is show you how to identify patterns that repeat over and over and over again. As the course goes on, we're going to look much more in depth at how to identify all these patterns, and we're going to look at charts on top of charts to get a feel for exactly what we're looking at and where the high probability trades exist. But as an example, here is an inside bar pattern that I'm referencing. And if you look at this candle here in the middle, you'll notice that as price moved sideways to higher, we never came close, or we never closed above, I should say, the high of this candle, which happens to be 22.6925. We made a high in this candle of 22.6925 and then backed off. So the strategy in terms of trading inside bar patterns that you see here is, can we identify a level where we would like to have price go to but not surpass, with the understanding that price will normally back away from that level? And I know it's a mouthful, and we're going to get much more into this. We're going to look at many more examples like this, but let's just take this one as the first example. So let's do it again. The candle where the arrow is pointing is my point of reference for what I'm terming an inside bar pattern. That candle is my line in the sand. Any 10-minute close, because we're on a 10-minute chart, any 10-minute close above that high and the pattern is broken, therefore the trade no longer exists. But right now, what the trade would be in this scenario is we're trading sideways to higher into the high around that red candle high. The closer we get to that red candle high is where I would be interested to play the short side for a trade lower out of this pattern. So when price came into that high or near that high right here, that's an area where we would be looking for an entry point on the short side, with the understanding that if this pattern played out, it would play out to the downside. And as you can see, it did play out to the downside, going lower until we reached an interim low right down here. Later in the course, I will show you exactly how you'll know how much to be looking for on a trade like this. We're going to teach you how to identify what a target price is to exit a trade. Another point of interest on this pattern is, even though price found an interim bottom, continued to trade higher, we never closed above the high of the original candle, and the market then went lower once again, and even lower beyond that. The important thing to realize is the market goes in steps. It's from one level to another level, whether it's on the up or the downside. And then it finds support, and then it trades in a range between another two levels. It finds another level on the downside and a level on the upside. And that becomes the next range. As we go, what we're doing is we're adding one building block at a time, so that as the course goes on, as I discuss different techniques, different strategies, different chart patterns, different ways to identify support and resistance, every time we talk about one of these things, you'll have a bigger foundation and a more strong foundation from which to understand the next set of information. And that's exactly what we're doing. We're definitely going to come back to inside bar patterns in depth, because that will be the bread and butter of your trading going forward. The majority of the money you will make in the market will be based on inside bar patterns. We're going to see plenty of them. They all look different, but when you pull back the curtain, they're really all the same. It's based on the pattern developing and the time it takes to complete the pattern. And you're going to understand how to put both of those things together to have successful trades going forward. So how does time play a role? Time of day, charting, time frames, these are very important components that we have to use in our entire trading strategy. Time is more important than price. Write that down. Time is more important than price. There are a number of different ways that we're going to use time with our charting strategies. The first is time of day. Traders need to understand what the premium times are to trade and what the premium times are not to trade. That will save you plenty of frustrating trades going forward. So let's understand the different components that make up the time of day and how we need to use it. So let's break it down into really 3 sections. The first section is the beginning of the trading day, the opening bell for about an hour to an hour and a half. So the first 60 to 90 minutes of the trading day are premium times to be trading the market. Whether you're trading the S&P or you're trading individual stocks or anything else, that will be your premium time, the beginning first hour to a 90 minutes of the trading day. That's when the most activity takes place. That's when the majority of the volume comes into the market. That's when the biggest moves happen in whether it's the S&P or individual stocks. Within the first 90 minutes of the trading day. So whether you're taking a long trade or a trade on the short side, if it's in the first 90 minutes of the trading day, as long as you have the proper price, the proper pattern, and the proper time component, that's okay whether it's on the short or the long side. But as we move in to the middle portion of the day, around lunch and slightly beyond, we have to realize that the volume gets extremely light across the markets. The computers tend to take over the trading. You have computer algorithms that tend to take over the majority of the trading. A lot of human aspects of trading are gone or have left the market for a period of time, and therefore it makes certain types of trading much, much more difficult. For example, unless we have the ultimate setup, we don't really want to short the market around lunchtime because there's less volume typically, and this doesn't apply to every day. The 80-20 rule applies, where 80% of the time you don't want to be shorting in the middle of the day, and 20% of the time you're going to have a good trade no matter what time of the day it is. But as far as 80% of the time, we're not interested in shorting the market, whether it's an individual stock or the S&P itself during the middle of the day. We can look for pullbacks in the market during that time frame, and we can look for long trades because the path of least resistance in the market is always going to be up. So if you did have light volume and it was the middle of the day and you had a sufficient pullback or retracement in the market, which we'll get to, then yes, that would be an area that you can be looking for a trade to the upside in the market. We'll talk much more about this, but I wanted to lay the groundwork, lay the foundation for why we need to understand the different times of day and how they play an important role in which trade you should be willing to take for the highest probability trade setup. That's what we want. We want high probability trade setups for ourselves. The third portion of the day, or the third section of the day, is towards the end of the trading day, the last 60 to 90 minutes of the trading day, where volume will have a tendency to pick up a little bit and there will be more activity in the latter part of the trading day. So if you have sufficient pattern and volume comes back into the market, then shorting the market becomes a viable option again. But again, remember, in light volume, the path of least resistance is typically higher. So those are your 3 time frames or time components of the trading day that we need to be aware of. There's other time factors that will come in. We're going to get into that. For now, the 3 different time components of the trading day are important. We need to make sure that we understand and write those down. So just so we can get a visual on the volume aspect of the trading day, if you look at the bottom of the screen, the black lines are volume. The black lines down here represent volume in each candle. So what you can see here, this was the beginning of a trading day, and you can see volume came in. And as the morning went on, even each candle, the volume got lighter and lighter and lighter until it dried up to next to nothing. And then towards the end of the trading day, and this is the end of the trading day, here is the last hour of the trading day beginning right here at this low. This is 1500 hours, 1600 hours, or 16 and a quarter is the end of the trading day in the futures market. And you can see here where the volume picked up towards the end of the trading day. Next trading day beginning, heavy volume. The volume tapered off and then came in at the end of the trading day again. And you typically get that repeat almost each and every trading day unless we're looking at some anomaly in one particular day or another. But 80% of the time, that's what you're going to see. Heavy volume in the morning, light volume in the middle portion of the day, volume comes back in and picks up towards the end of the trading day. Very, very important. How about chart time frames? Why is that important? And really, what am I talking about when I discuss chart time frames? I use 3 specific time frames the majority of the time. Of course, there are other times where I'll use a lesser time frame, meaning less than a 10-minute chart, and there are times when I'll use a very large time frame to get a read on the market, to find support and resistance, or for another reason when I'm doing some analysis. But primarily, 80 or even more % of the time, I'm using 3 time frames: the 10-minute chart, an hourly chart, and a daily chart. I get a lot of questions, why don't you use a 5-minute chart, or a 3-minute chart, or a 7-minute chart, or any other chart, 15 minutes? You can use all those charts. The chart patterns will play out on really any time frame. I've found that the 10-minute time frame for intraday trading tends to work the best in terms of the patterns that we're going to be discussing. So for example, a chart pattern may take an hour to play out. It may take 3 hours to play out. And I know how many candles that represents, so I'm used to looking at a 10-minute chart. 6 candles is an hour, and so on. I use 10-minute charts because I find that each individual candle has enough data in it to be sufficient for what I'm looking for on the chart, and it gives me a very good picture of how the pattern that may developing is developing. What's more important is looking at other time frames. If I look at a 10-minute chart and I'm not sure exactly what's developing, or I see conflicting data on the chart, the first thing I want to do is go right over to the hourly chart so that I can clear up some of the back and forth nature that happens on a 10-minute chart, and I can get a better bird's eye view of what the larger pattern is telling me in terms of which direction the larger move is going to occur in the market. Now here's an example of something that you're going to learn farther down the course. If I take this level right here, and the price level on low was 2248.50. That was the low. If I'm looking at a 10-minute chart and the market is in that area, and this is all I see on the chart, or maybe I would have seen some information from the past, so I'll move the chart over a little bit. And you can see here that really having a difficult time finding a point of reference on why the market may or may not find support in this area. What we do notice is that we had a down move and we started consolidating in a bearish pattern down here. My expectation would be for another move lower. But if I look at an hourly chart around the same zone or at the same time, I would notice that there was little reason why the market would be headed lower immediately from that level. And this is something that you're going to learn throughout this course. So for example, we're looking at the same area we just were, which is the low right here at that same price level at 22.48 and change. Now I can tell you from looking at this chart on the hourly chart, and we're going to learn plenty of this as we go forward, I can tell you there were multiple reasons why that this would have been more of a buy area than a sell zone because of certain conditions that existed on the chart. For example, it was a pretty solid retracement area. It was a pretty solid area where the chart was telling us that that price level was important, and I can identify other areas on the chart to prove that case out. We're going to look at those things as the lessons go forward. What I want to do right now is just wet our whistle a little bit and continue to build the foundation, so when we discuss this in depth, you'll reference back to this portion of the video or the lesson and say, aha, now I fully understand why that area was more of a buy zone than a sell zone, and certainly because we were able to identify on the hourly chart what the likely scenario unfolding was, as opposed to just looking at a 10-minute chart. These are the things that are extremely important. And when you learn these things, it's what sets you apart from the majority of the other traders that are your competition out there in the markets. Before we move on, I'll give you a sneak peek at what I'm referring to. What's happening here is the chart is telling us that this price level in and around 22.52, 53, 51, 50, in that neighborhood is extremely important. How do I know that? One of the reasons is, and there are more than one, but I'll give you one right now. One of the reasons that I know that's important is we made that reversal here back on the chart. We traded into it here and stopped short. And what if I just scroll back the chart a little bit and see what happened in the most recent past? There's another area here that makes sense. The market found support, a little bit lower, but still supportive of the market. You can tell in here, this was resistance to the market before we gapped over it one day. So you can see that the market is telling us that that price level is important. Not because I said so, it's the market is telling us by looking at the charts, just with our own two eyes, that visually that price level has importance. So we want to make sure we're aware of that, and that now we can begin looking for other reasons why that price level would be supportive at that point in time. And there are other reasons why this price level would be supported by the market, and we'll get into that in the next lesson. I also mentioned that the daily chart was important, and some traders would say, why do you care about the daily chart if you're trading intraday? And the reason is because I certainly want to understand where daily highs and daily lows exist. Daily highs and daily lows will generally be supportive or resistant to the market. So as price would come into a daily high or daily low, I want to be aware of that because I want to be looking for another reason why the market would be supportive or resistant to those price levels, not in and of themselves, but I want to find multiple reasons why, multiple conditions why I would be willing to take a trade at a certain price level. So each day, I want to make sure that included in my analysis of where we may find support or resistance during the trading day, I want to make sure that I understand where previous highs and previous lows exist, previous closing prices of the S&P on the high side and the low side. I want to understand these levels, and they do play into where I would be looking for support and resistance, and we'll get more in depth when we discuss support and resistance and how to identify where we're looking for those areas during the trading day. There are many other ways that we're going to learn how to determine support and resistance areas in the market. We're going to learn them one at a time as we go forward, like the rest of the building blocks. So let's begin to discuss one of the ways that we look for support and resistance areas in the market. So we know the market doesn't trade in a straight line. The market goes up, the market goes down. The market trades in ebbs and flows, just like our lives go in ebbs and flows. Businesses go in ebbs and flows, whether it's by the day, by the week, by the month, or by the year. Everything also applies to the market. The market will tell you where price is important. Instead of you determining where price is important, let the market tell you what that price is. For example, the line that's drawn across the screen was drawn because of, just on the snapshot of what you're seeing here, this price level seems to be important. The market came up to it, failed, tried it again, failed. So I'm going to say, for the purposes of this lesson, that price level is important. What happens when we come back to that price level later? Well, we happened to get through it, but came down again, couldn't do it. The market could not get through that price level on a sustained basis. We traded lower, we tried it again, couldn't quite get there, traded lower, tried it again, couldn't quite get there. And this is the way the market trades. So when I know that a price level is important, in this case, right around the 2270 level from what you see on the chart, I know that next time through, the market is going to have a difficult time getting through there. And if it does get through there, I'm going to look to my next resistance zone. But how do we use this when trading? We're going to get much more into that and how we put everything together by knowing where resistance or support is. Remember the time factors of how time plays an important role. Pattern plays an important role. When we begin to stitch these things together, you're going to very clearly see how putting time and price and pattern all together on the table as pieces to the puzzle, you'll start to see how you can begin to understand what the next likely move will be in the market based on a high percentage of the time. Nothing will ever work 100% of the time. But what we can do is narrow down what the likely scenario is 70, 75, maybe even 80% of the time in some cases. If you have proper money management and you can win over 70% of the time, that's a recipe to make money in the market. Now let's see if the 2270 area really is important to the market. What happens when we go forward? You can see here we got slightly above it and failed. We got above it again and failed. You see how important 2270 is? As this course goes on, you'll be able to identify what price levels are important, and you'll also be able to identify, if you take a trade, where are you wrong? The most important thing that you can know when trading is where you're wrong. That's what most traders lose sight of. They don't understand when to cut and run. You're never going to win 100% of the time, so you might as well understand how to lose small and fast. Write that down. That's the foundation that I wanted to get across for support and resistance, but we're certainly going to expand on how to determine support and resistance as the course goes forward. We'll cover the remaining portions of what do you see in the charts in the following lesson.